The Moving Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusable isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusable.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours.
When you partner with Axon, you immediately gain access to a full range of products and solutions designed to meet the complex needs of today's grower. We carry all major brands and sizes of tires and wheels. We specialize in large diameter wheels for large equipment. We have one of the largest OEM replacement wheel inventories in North America. Known for extreme flotation setups, duals, and triples, we have wheels for all makes and models of tractors, sprayers, combines, and grain carts. If we don't have the wheel in stock, we'll custom build, sandblast, and paint in-house. There isn't a more vast inventory in North America dedicated to helping dealers move more iron. With facilities on the West Coast and in the heart of the Midwest, leverage our 230,000 square feet of indoor inventory to solve any problem a grower may have. Move more iron with Axon.
At Big Iron Auctions, customer satisfaction is our #1 goal. As the 40-year leader in auctions for agriculture, real estate, livestock, construction, and transportation, we are here to serve you. Big Iron will handle everything from start to finish. From meeting with you, to prepping your equipment, writing the listings, and collecting buyer's payments, let us do the heavy lifting for you. We love our customers, and we treat them like family. There's a Big Iron sales rep in your area, so let's get together. To learn more, visit bigiron.com.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here. Moving iron.
Hello and welcome to Moving Iron Podcast. Marks with Sean Hackett. Sean Hackett is with Hackett Financial out of Boca Raton, Florida. He's nice enough to come on and talk about what's going on in the world of commodities. Sean, how you doing this morning?
I'm doing really, really good. I'm excited to be going up to Orlando for a seed conference and continuing to spread the good word, at least the way we see it. So
The gospel of Sean Hackett. Spread it all over
the
the world,
the
baby.
ag gospel of Sean Hackett. There you go. There you go. Let us pray.
Right on, my man. All right, got a lot of stuff to talk about. We had the USDA report come out yesterday, and pretty well pegged what you had said. You thought there was going to be a run between 1.7 and 1.9, somewhere in there, kind of fall in that 1.7 range, and by golly, if that didn't happen. So, Shawn, talk a little bit about what you saw there and the effects that you saw in the market.
Yeah, when everyone was panicking in August and saying $3 corn, here we come, 2.5 million bushel carryouts, everyone was telling you need to buy, you need to buy 375 puts is the way to make money. We kept pushing back on that idea that the market was grossly miscalculating last year's crop being too high and was grossly miscalculating demand, and that our ending stocks, when we came down to actually finding out what it really would be, we thought by January they kind of did a little sooner than we thought. We thought they'd get to 1.7-ish by January. They got to the December report, and they may still go lower. Wouldn't be surprised they went a little lower in January. But they're now here, and we argued that a fair value for corn with a 1.7-ish billion bushel carryout is somewhere at this moment in time, based on all the current metrics, is between 4.5 and 475, not 3.5 to 375. And so where we've gone from is we went from 380 corn, and now we're at 450 corn. So the move in corn is totally rational. It's based upon a dramatic mistake that the majority of the analysts made on a fundamental view of corn. And now we're at a point where 1.7 based upon demand, Casey, it's enough. It's not a shortage, but it's not a surplus. It's just, it's adequate. And what adequate means, anything on the supply side or the demand side that changes from here just a little bit, and you go from adequate to worrying about being inadequate. Second crop corn, U.S. planting season, U.S. growing season, Chinese stimulus, U.S. dollar. There's a lot of anything. I think people really understand how much corn is on a razor's edge. To go from adequate to not adequate. I don't know how many acres we're going to plant in the U.S. It's too early to tell, but it wouldn't take much of a one low, one mid 70 crop yield, which is just mildly below trend, Casey, and we could be putting ourselves right back into bare minimum pipeline levels in corn supplies, and it's just the market has been has bought into a lie that corn supplies are abundant, and we are slowly but surely peeling away that lie. And I'm pretty excited about the corn price potential for 2025. And our minimum outlook for the growing season in the U.S. specifically, is that we're going to have a much more unfavorable weather pattern than the one we had going last year. And, we're going to have a neutral, negative, potentially weak La Nina state, not going to be transitioning from La Nina to El Nino or El Nino to La Nina. And based upon the 89-year Gleisberg cycle that we've talked about on your show many, many times being due in the next 1 to 2 years, everything says to me that the prospects for having a corn crop at least come up a little bit short in the mid 170s versus what we had this past season, at minimum, is a pretty high probability forecast. And I also think second crop corn in Brazil has a very high probability forecast of also being off ideal expectations. And that's, I think, all you're going to really need to get some more exciting prices here. So farmers really need to be, I guess the way we're handling this, Casey, we want to use the old crop that's sitting in the bin, keep the farm going. We argued at the lows in August that you should only sell, if you have to sell anything, sell what you only have to and hold the rest. Obviously, as we start rallying, as we have, think about this, Casey. We're already 65 to 70 cents off the lows in August already. Yeah. And the cash basis is stronger. So cash markets, in many markets, is actually up sometimes 80, 85 cents off the low. So think about that. So you got to keep the farm going. You got this old crop supply in the bin. You got to, the market's not going to go straight up. There's going to be corrections. 450 to 475 is overhead resistance. I don't think we're going to go through it for a little while. Keep moving grain, keep moving corn, keep moving cash, keep the farm going. But I'd be very, very, very reluctant to want to do too much of new crop, of next year's crop, of the crop to come. I would want to keep my top side at this time more open, and I'd want to use the price rallies we see for old crop to monetize the farm, to keep it going, keep your top side open on the old crop. To the extent that you don't have storage, to the extent that you don't like that strategy, that you want to, that you want to sell you want to sell some of that new crop because that's just the way you want to do it. Look for opportunities to protect the upside. Bottom line is, however you want to slice and dice a strategy, we want to keep the next crop's supply topside open. We think that's the strategy that's going to bring the most money home on the farm.
Yep. There's the movement that we've seen since basically the election upward has been, just in this time, just since the election time, you've seen the price of corn almost move 50 cents just in that time frame. So it's very not quite 50 cents, more like 35 or 40 cents, but nonetheless, it's been a big jump over the last time, and we've seen some stalling out and some taking off. But you're pointing to some things there that show, hey, and I think the market's now realizing that, like, hey, we are on, like you just said, like, we've got just enough to make sure, if everything goes like it should, we're going to be okay. But have things move slightly one way or the other, and the wheels on the bus.
We know corn and wheat and corn, one drives the other. They certainly have a modulus of elasticity with each other. And if you look at where corn prices are, where wheat prices are, where cash prices are, we're starting to see winter wheat prices becoming competitive on a feed side basis. Pretty, in any time I've ever seen the wheat price for feed be competitive with corn or pretty close, that's a really unusual time for wheat. You don't typically get there very often, and it does tend to also suggest that the wheat market has mispriced itself to the downside. And if you look at what the price action, Casey, of last week, 540 on SRW wheat was the August low. We hit it intraday last week, and now we have since, on the March contract, we have since now bounced 23 cents off the lows. It sure looks to me like that was a successful secondary retest of the August lows, and now we're about ready to trade the fundamentals of wheat, which is Russian wheat prices. Russian wheat exports are withdrawing from the market. Russia, Ukraine had a terrible crop. Their current crop is horribly rated, one of the worst rated crops in at least 25 years. We expect all kinds of problems in the spring, especially from a new round of frost risks. And we expect that they're going to have a second bad year in a row for winter wheat. And without Russia selling all kinds of supply, the actual stocks to usage ratio for exporter stocks relative to demand is at the lowest it's been in 10 years. So once again, the market has bought into a lie that there's all this wheat. And to some extent, they were correct that as long as Russia was there to sell, there was enough. But that was their overselling of wheat that they now no longer can do. And so I think that the wheat corn combination is I think that is an exciting place to be looking. Soybeans are just not as exciting. We've talked about it for a long time. We have stocks to usage is not as exciting. It's getting a little better. It's not as bad as we thought, but soybeans are going to be dragged up by corn and wheat. Soybeans are not going to drag corn and wheat up, at least right now. We're still watching weather in South America. The market's convinced the crop's been made. We still haven't completed setting pods. The dry weather and the heat that's there and the floods in the south don't suggest to me that we're going to have a 170 million metric ton crop. I don't think it's going to be a disaster either, but at the same time, I think something closer to 155 to 160, I think, is a better number. But it might take until the combines roll in January for the market to start shifting their consensus that the crop's already done, it's in the bin, it's set, and it's big. It might take until we get harvest rolling here in about another month to change that. Either way, I'm least excited about soybeans, but at the same time, if corn and wheat fundamentals are strong and corn and wheat are likely to continue to trend higher, it's hard to see a material decline in soybeans with that situation, Casey. And so overall, if you get rallies in soybeans because of weather in December, or if you get a rally in soybeans because of corn and wheat going up, you got to use those opportunities because we certainly have plenty of soybeans at the moment, and unless our renewable energy policy, we get a clear direction on what that looks like. That's a market that's a little that you have some more urgency to sell, absent some verification that the crop in Brazil is smaller than we expect. Overall, I'm not excited about selling here, but it's and if I'm looking at the overall grain complex, Casey, right? Because obviously, soybeans are driven by the price of meal and the price of oil. Bean oil is trading at the lowest valuation to foreign vegetable oils in a decade, meaning we are the cheapest vegetable oil in the world. Our exports are gargantuanly up from what it normally is, and so bean oil is going to continue to sell off the rails until the bean oil price normalizes to the foreign vegetable oil price. And the same thing is going on in meal. The exports are off the charts. We're the best game in town, and we're trading at COVID lows. So based upon the components, meal and oil, and my strong belief that both those component prices are going to be rising, that means the crush margin is going to improve. That means the demand from processors domestically should improve, and that should help bring some upward trajectory in soybeans, at least from domestic demand, especially if wheat and corn continue their upward trend. So that's, I think, the yin and the yang of all the grains and what I'm seeing happening. Least excited about beans, most excited about corn and wheat. Obviously, if we get some more protracted weather issues in Brazil or in Argentina, maybe the soybean story can get a little more exciting. But for right now, I think that's the correct way to approach grain markets in aggregate.
Yep. A lot of moving parts there. All right, let's talk a little bit about what's going on in the cattle market for just a little bit. You've seen some stuff there with screwworms and those kind of things that are got people kind of fired up. I guess as you look at the what's going on in the cattle market, again, they're just about the time you think the cattle market's going to kind of fall out of bed a little bit, it bounces back. So I guess what you see happening there, Shawn.
My experience with animal diseases, avian flu in dairy, the latest African swine fever, is you get the initial trade.
Mm-hmm.
Oh my gosh, it's going to spread everywhere. It's a disaster, and everyone's going to die. Yeah, the animals are gone, and it rarely works out that way. So we have this screwworm concern that we hadn't seen in a long time down in Mexico, and it's going to spread here. And no one can predict all of that, what it's going to mean. But my experience is you can only trade an animal disease for so long, and most of the time things work out better than the market initially fears. And that's why I think that we're not likely to be able to. I don't think we're going to be able to break out of this cattle wedge pattern that we've been in since last fall, Casey, based upon the screwworm. What I think needs to happen is I think we need to have speculators who are up to their eyeballs long cattle because of screwworm to get tired of owning cattle, sell because the screwworm story is no longer, a hot button, get that correction in the market to the lower end of the wedge. And then at that point, I think there could be some more excitement in cattle to potentially break out to the upside on some signs that actual animal retention and herd rebuilding, might be taking place here. That's not a this year story. That's probably sometime mid-late first quarter story. So my expectation would be that if you're a cattle producer that needs to do something or wants to do something in the short run, doing something now at this upper end of the wedge pattern into the, before the end of the year or before we get into the January, where I think a correction is going to occur, this might be a good place to make some cash sales, maybe lay out some LRP under the market, the subsidized government program, some of those things. That would be my recommendation at this time for cattle producers to be thinking about right now. I don't think screw room is enough. I could be wrong, but I don't think screw room is enough to break this market out to the upside. But that is what's keeping it stubbornly high for now, but I do think it's going to give way.
Okay. All right. Let's talk about hogs in the same breath. They are they're just turning over right now, I guess. Best way to put it. I guess as you're looking at the hog market, your thoughts there, and what do you see as some opportunity in the hog market?
Yeah, I mean, hog producers need to get some cash sales on the books. No doubt. No doubt. You got to do something to protect the downside price risks. We've been adamant about this. We had this significant rally. The USDA completely missed the mark on U.S. animal numbers, weights, and production. They thought it would be up substantially. It was flat to down. The market reacted as it should. But at these price levels, Casey, on hogs and the current price level for pork cutouts and the overall desire of consumers for pork products, the chart pattern, if you look at the April contract, we got into this 95 cent area. Speculators up to their eyeballs long the market. I think this is a very, very good place for hog producers to be doing whatever they feel they want to do, whatever they're comfortable doing, but make sure they can lock in, protect this economic price. I don't think it's all over. I don't think this is like the top for years, but boy, this is a good opportunity to lock in some good economic advantage, which has been scant in the last couple of years. But this is a good opportunity to bring some more money home on the farm. You have to pick your spots. This is a time to do it. Yesterday's action is clearly suggesting we might be rolling over in the market technically. And I would strongly urge producers to be thinking about taking advantage of the current price level. And I'm basing it on the April contract, based on whatever delivery month that you're interested in. But I'm basing my work on the April contract. So
okay, right on. All right, lastly, let's talk a little bit about China. China is going through some quantitative easing, I guess, and they are looking to set up another round of that because what they did the first time really didn't do much. I guess as you're looking at this, Shawn, you've been talking about this for a while, that, hey, there's an opportunity here if China really comes out this hard and really brings some stuff in and starts flooding the market with cash, that it could be beneficial for things like cotton, things like soybean meal, those kind of things, like stuff that crude oil, those kind of things that China really buys a lot of. As you look at this situation now, Shawn, what are your thoughts, and have you changed your opinion at all?
I'm gonna give this analogy. I was in South Dakota last week, and what I like to do is I don't like pressing my suit and tie, and I like putting a hot shower on and steaming it, and you shake it around, and all is well. That's my secret, by the way. For anyone who doesn't know it, that's my secret.
That's a good one. I use that one myself.
And I'm sticking to it. Yeah. But little did I know that the tub drain was closed. And I got on an extended call, and so I go into the bathroom, and the water's almost literally almost coming over the top.
Yeah.
So luckily, that didn't happen. But I went down and I put the drain up, and the tank is, the water starts to go down. That's what the Chinese economy has been doing since the real estate crash from a few years ago. The China economy was like this, and the water level's been going down at a rapid pace. Problem is, you don't want to run out of water.
Right.
Can't take a bath if there's no water in the tank.
Makes it hard.
So you start looking at the water level, and you say, okay, well, what do you want? 3/4 full? Half full? Well, at some point, you say, I got to slow this down, right? So what do? Usually on a drain, you got a couple of settings. You have a fast drain. You got a slow, like a mid drain. So you put it in the mid drain. And then it slows down a little slower so you can manage it better. That's the first stimulus that we've seen. That first 1.4 trillion that they pushed in, it slowed the decline. And I think they're now starting to feel that they're now getting pretty close to the level of the tub that they want to stop it from falling any further. And that's going to be this next stimulus that I think they're starting to talk about that they're going to put into the market. At some point, however, what happens is if you're in the tub for too long, the water gets a little cold. So what do? I mean, I'll tell you what I do. I get out and I turn the faucet on again and get some hot water in there so it gets hot again, and you go back in. That's what I do, right? I don't want to get too personal now. But so once they're pretty comfortable that they've gotten the right level but they want to heat up. They want to heat up the water a little bit, meaning heat up their economy. Then they're going to do another round, and that's going to get the water level to slowly rise. That's the best case scenario, is to get the water level to slowly rise and get the water hotter again, so that they have at least an economy that's functioning, that has some opportunity, and where some demand comes back from the consumer. That's the best analogy as to what I think is going on here. They slow the rate of decline on the first. They're now going to stop it. And then the one after this one, they're going to start heating up the water again. That's what 2025 is all about, is getting the water in the tub hot enough so that the consumer can buy enough so that their economy can function better, and the situation within China is at least stable to positive. And for markets like crude oil or natural gas or soybeans, or for cotton, things that they buy a lot of from others, those are the markets that would be disproportionately positively impacted by this. It's not an overnight success. It's going to be a process, but futures markets are futures markets. They will get ahead of this once they're convinced. They're not yet convinced, but once they're convinced that that's outlook is going to occur, before we even get to the good times, they're going to start moving these prices well in advance. And that's always the rub. You can't wait for the numbers to be fantastic to start buying cotton, or, as a physical buyer, you have to anticipate while things are still not looking good. And that's always the secret. You still have to, the best opportunities are when corn was great when it wasn't clear we're going to have a 1.7 billion bushel carryout back in August. You had to foresee that coming. You had to forecast months in advance what the market was likely going to be talking about back then. Everyone knows what people are talking about today. Everybody knows what happened yesterday. You don't need me to tell you that. What you need me to try to tell you is what's my best guess as to what they're going to be saying 3 to 6 to 9 months from now. My suggestion is China's economy on the mend, Chinese consumer doing better, Chinese demand better, Chinese imports better, and that's going to be the story for things like cotton that are going to make the current depressed price probably look a little better when that time comes. And I think that's the best synopsis that I can bring to the table, on the China situation, with probably the worst analogy possible, but that's the way my mind thinks. So
we'll let it slide, Shawn. I think that'll work all right. Appreciate you breaking that down for us.
You're welcome.
All right, Shawn. I think last thing, we're coming up here towards the end of the year. We've got a few things out there. We're going to do one more podcast here, probably the week of Christmas and New Year's, kind of lay out the groundwork for what you see kind of 25 shaping up to be, and what that might look like, and if everything happens the way you think it will, kind of what that's going to play out. So look forward to that. I guess, Shawn, as you take a look at the remaining part of this year, where we see things moving right now, the week between Christmas and New Year's typically is not a lot happens, right? But I mean, with all the stuff we see right now, with all the geopolitical stuff, those kind of things, would you anticipate seeing something of any kind of magnitude? And that's, since usually it's zero, anything is an order of magnitude. But I guess as you're looking at this through the end of the year, what's your anticipation for possible more upside to corn or soybeans or something like that? I mean, what's your thoughts as we look through the end of December here?
Because of the incredible geopolitical instability, and because of the tremendous U.S. Political transition that we're going through, in normal years, I wouldn't anticipate anything really changing much into the end of the year, and that may still be the case. But if there was ever a year for some fireworks during a normally quiet time, this would be the year that it could happen. I mean, I would be on guard for some surprises. I'm not anticipating them necessarily, other than I think if, in most years, I think the odds of a big move in December are very, 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 very low. But in this year, they're probably the highest that we've seen in a very, very long time. So I wouldn't discount some surprises. If they occur, and if we get some outsized moves during a time of lower liquidity, which December typically is the closer you get to Christmas, there could be some opportunities to buy or sell depending on which way the volatility goes, Casey. I think the period from here until January 20th is going to be a high risk period for all of that, whether it's the month of December or not. But definitely you have to stay on board with this move to January 20th. A lot of players all over the world that have a lot of agendas that are going to try to position in certain ways ahead of the new Trump presidency. And of course, this new explosion of Middle East unrest with Libya and Damascus falling, and Assad looking like he's finally out after all this time of being there. I mean, just a lot of stuff going on, Casey. I just don't think the next 30 days are going to be, docile. Can't predict whenever the headline's going to change, but just be on guard. We could see some really wild situations leading up to January 20th, and even once he gets into office, because there's going to be a period that he doesn't have his cabinet in, that he doesn't have his generals in, that he can only do certain things. It's going to be a very vulnerable time where the market might try to take advantage of, him not having all his chess pieces to play.
Yeah. Okay. A lot of stuff going on, man. The whole Syria thing with Assad and all those things that happened.
I remember when I was a kid in the 70s and Assad was there and all this stuff, and to see that he's fled Damascus, and just wild, absolutely, just a wild situation. Very, very. It could be good, it could be bad, depending on who gets in. These things are very dynamic right now, but it is a wild dynamic in how the Middle East, Turkey, the Ottoman Empire, how all this gets resituated is going to be really important to how the Middle East resets itself. I mean, this is a reset. Let's just call it what it is. Israel's going in there now and starring. I mean, it's volatile times in the Middle East, and whatever happens in the next 6 months to 1 year with this whole Damascus and Assad situation is really going to set a new course for the Middle East. And with that, it's going to set a new course for the global monetary policy, the geopolitical policy, and how commodities trade around it.
Yeah. Scary thing about the whole Assad thing, it's like every other country in the Middle East. It feels like when there's something like this happen, it creates such a power vacuum that it brings in the wrong actors, and we have a Libyan mess, for example, where we have what we see happening in every other country.
Unfortunately, too many times you replace one bad actor with another bad actor, or sometimes even a worse bad actor. And I hope I hope and pray for the people there that this is a different outcome. It's not up to me. I can only hope and pray that happens. But unfortunately, the history of the Middle East is more often than not, that you don't actually get a better situation. You just get a different bad situation. Time will tell how this plays out.
Yep, for sure. All right, Shawn, appreciate you being on the podcast. Look forward to your vacation next week, and try not to show up too many people on the slopes while you're out there shredding. So,
if I feel I'm going to hit somebody, I'm just going to tell them to go buy corn, and they'll quickly get out of the way.
Just keep yelling buy puts and options on the way down. That way, it's a safe landing when you hit, right? So
buy corn. Ooh, they're just going to keep moving out of the way.
Right on. Well, Shawn, take care of yourself. Have a good trip, and we'll catch you again the week there between Christmas and New Year's.
Thanks, Casey. Appreciate it. Thanks.
Right on. I'm Casey Seymour with Moving Iron Podcast. Check me out on Facebook, Twitter, and Instagram at Moving Iron LLC. Go to LinkedIn at Moving Iron Podcast. Check out the video version over on the YouTube channel, which is the Moving Iron Podcast YouTube channel, and you can see everything that you need to see at movingironllc.com. So with that, I am Casey. Oh, also on TikTok. Check me out at Moving Iron Podcast there. So with that, I'm Casey Seymour with Sean Hackett. Let's do some iron, folks. Out. Iron Podcast is brought to you by these great sponsors. Are you looking to value your equipment more accurately, target the right buyers and close more deals, reach your ideal customer? Then look no further. Fusable isn't just about ag data, it's about action. Our best-in-class solution empowers you to value your equipment accurately, make informed decisions, and find the perfect prospects. Ignite your dealership's growth at fusable.com/movingiron-podcast. Out in the field, every decision counts. You wouldn't plant without testing your soil, so why would you prospect blind? Introducing EDA, your one-stop shop for ag equipment intel. EDA goes beyond specs and prices. You get deep dive data on every piece of equipment like UCC filings that help track ownership changes and uncover potential sales leads. D&B firmographics, which help you understand the financial health and buying power of potential customers. Market trends that help you stay ahead of the curve, and insights on equipment demands and pricings. With EDA, you're not just looking at data, you're seeing opportunity. Find the right buyer, sell smarter, and build lasting relationships. Visit edadata.com for your free demo and unlock the power of knowledge. For over 80 years, Iron Solutions has been your go-to data source for ag dealers, lenders, and manufacturers. Get powerful appraisal and value forecasting tools that fuel profitable decisions anytime, anywhere. Get your free demo at ironsolutions.com. Iron Solutions, confidence in every click. Today, there are many ways to finance ag equipment, but nobody delivers simple, fast, or flexible financing like AgDirect. Learn more about your options to buy, lease, and refinance equipment at agdirect.com. Valley Transportation has been hauling ag and construction equipment across the country for the past 33 years. Call Parker at 800-657-4910 for all your trucking needs. At Valley Transportation, our goal is to help you reach yours. This podcast is proudly provided by Axon, helping dealers move more iron for the past 100 years. Find out more at axontire.com. Move more iron with Axon.
Moving iron in the 21st century. Hard-working people working hard for you and me. Moving iron time and time again. Through the years you'll find us here.